In this episode, we will dive deep into our exclusive liquidity sweep trading plan that might revolutionize the way you approach the market. This trading strategy consists of 3 basic steps you must follow. Firstly, spotting a valid single candle liquidity sweep pattern on the higher time frame. Moving on to the second, zooming into the lower time frame and searching for reversal patterns. Third step, setting up entries based on fair value gaps and order block. Before we get into the strategy, if you find this helpful, please give it a thumbs up. And if you're new here, subscribe to our channel and turn on the notification bell, so you never miss our latest uploads. We'll see you right after the intro and disclaimer. Firstly, in a bearish scenario, a bearish liquidity sweep pattern is formed by a single candle that sweeps the liquidity above the previous high. This particular pattern usually appears just before a rapid and significant downward move. It is crucial that the price sweeps the liquidity of the highest point of the previous structure with only one candle body or wick. Additionally, the next candle's body or wick should not exceed or close above the first candle's body or wick. We want to see an immediate reversal in price direction, with the price moving back below the high after the sweep. Secondly, in a bullish scenario, a bullish liquidity sweep pattern is created by a single candle that sweeps the liquidity below the previous low. This specific pattern occurs just before a significant upward movement. We look for a liquidity sweep marked by a long wick or body, followed by an immediate push upward. The subsequent candle's body or wick should not exceed or close lower than the first candle's body or wick. Psychology behind this strategy. Let's examine the psychology behind the strategy, as it will help us build a clear understanding of how price movement develops in the market. To illustrate this concept, imagine structures like these that simulate price movement. Observing the structure, we can see the price initially moved upward, broke previous structures to the upside, and created a bullish break of structure. It also formed demand zones, each holding the potential to reverse price direction once revisited. After sweeping external liquidity, the price shifts direction to capture internal liquidity. This action is meant to fill the gaps that were previously left unfilled. In the following move, the price pushes downward, reaches the upper demand zone, and forms a minor upward reaction. This is due to buying pressure from traders who entered long positions in this zone. That small pullback further encourages more price action traders to go long, placing stop losses below the demand zone. We can then observe the price pushing lower, sweeping liquidity below the recent low with a valid bullish liquidity sweep pattern, formed by a single candle's body or wick, followed by an immediate push upward. The price then returns above the low after successfully clearing the liquidity through the sweep. At this stage, we have identified a valid bullish liquidity sweep pattern, offering a high probability opportunity to potentially execute trades. Why do we consider this pattern a high probability setup? We consider it high probability because, in this case, the liquidity below the recent low has already been swept. This indicates that many stop losses have been triggered, resulting in a sharp increase in buying pressure. Additionally, the price has begun moving upward with significant momentum, signaling a strong bullish bias. What's the core mindset behind the strategy? The core psychological principle driving this strategy is that when sell-side liquidity is cleared through a liquidity sweep, price is then drawn toward buy-side liquidity, aligning with its prevailing direction. When price sweeps liquidity on one side, buy or sell, it often sparks a shift in overall market sentiment. Now, shifting attention to the lower section of the screen, we observe an order block positioned at the extreme. The question arises, will price head toward the extreme demand zone, or will it reverse after forming a confirmed bullish liquidity pattern? Notably, in this scenario, you don't have to wait for price to reach the extreme order block before entering. However, if price bypasses the lower order block and instead creates a bullish liquidity sweep pattern, showing a clear change of character on the lower time frame, it then sharply moves back to the upside. So now we have identified a valid bullish liquidity sweep pattern. Our next step is to switch to the lower time frame, closely monitor the price movement, and patiently wait for the formation of a valid change of character pattern. After detecting confirmation of a market structure shift on the entry time frame, we can set our entry position at the newly identified order block or fair value gaps attributed to the change of character. When these conditions align, we consider a long opportunity with our target set at the external liquidity, which serves as the take-profit level. Furthermore, if the price fails to show bullish movement and also hits the stop loss, our attention shifts to the order block located at the extreme. This order block becomes our high probability demand zone for a buying opportunity. The reason is that the price has already used the upper demand zone as an inducement area, successfully sweeping the substantial liquidity accumulated below that zone. This liquidity mainly comes from the stop-loss orders of traders who entered the market aggressively with long positions. Our next step is to patiently wait for the price to reach the extreme order block. Once it arrives at this level, we can consider entering a long position after the creation of a valid change of character pattern on the lower time frame. Now it's time to move into real chart examples. We can see that price sharply cleared the liquidity above this high with a long wick. Following this, the price immediately reversed, closed below the highest range, and formed a valid bearish liquidity sweep pattern. So, we have identified a valid liquidity sweep pattern in the 15-minute time frame. Our next step is to zoom into the 1-minute time frame. Here, on the 1-minute chart, you can see that price created a perfect change of character by breaking below the structure to the downside. Moving on, we highlight the order blocks formed by the change of character. I am placing sell limit orders at the lowest points of both order blocks, and for the take-profit targets, I've set them at this recent swing low. Let's see how the market reacts and whether the trade setup plays out successfully. Let's look at another example. To set an entry in the 1-minute time frame chart, I am identifying the order block generated by the change of character. Moreover, we can also spot a fair value gap positioned just below the order block. In scenarios where order blocks and fair value gaps align, the best option is to set the entry point at the midpoint of the zone, including both the order block and fair value gaps. I place a sell limit order right in the middle of the zone to maintain a strong risk management approach. With the take-profit target set at this particular swing low, our sell order was activated, and after activation, the price eventually reached our take-profit target. Thank you for watching. I hope you gained real value from this video. If you did, make sure to hit that like button. It truly supports the channel and shows us you're enjoying the content. And if you're new here, don't forget to subscribe for more trading strategies. Thanks for watching, stay disciplined, stay consistent, and I'll catch you in the next episode.